My name is Marty Cameron. I am the head of our tax credits and incentives advisory group here at Sherry Beckert. Today, we're going to talk about everything credits and incentives with respect to what we do here at Sherry Beckert with a bit of a look back in terms of 2024 and what moved the needle for clients, but also what we think we see on the horizon for 2025. We're going to discuss each of these topics as we go through, and we'll break it up in a way that I hope makes sense to you. Let's get in here today. So again, I'm Marty Cameron. We're going to talk a little bit about what we see post-election in the credits and incentives world and what we think are things on which to pay attention. Talk a little bit about our group. At that point, I think I'll have each of our leaders in this group say hello and introduce themselves. We'll then get into some discussion on the Inflation Reduction Act and what we've seen over the past year and I don't know if what we can expect, but maybe suspect might happen next year. We'll talk a bit about R&D and what we see and have seen in the world of R&D, both credit and the capitalization requirements, and how we see that changing potentially going forward. We'll talk a bit about cost seg as well, and how that market has been evolving as we've seen bonus depreciation amounts like decrease and what we see on the horizon there too. We'll also talk about, from an energy perspective, 179D and the energy efficient commercial building deduction, and how the enhancement to that under the Inflation Reduction Act has affected the projects we do, and what we also see going forward with that as we see some prevailing wage and apprenticeship requirements hit. And then we're going to also talk about the general world of state credits and incentives, both statutory and discretionary. So with that said, we'll move on to the next slide. Post-election change on the horizon. Obviously, there are a number of tax proposals that we've been thinking about that may or may not have passed that came out in 2024. And then we think about what may happen in 2025. There's a few things under Tax Cuts and Jobs Act that are expiring or that we want to have taken out of being made permanent that will be important to us from a credits and incentives perspective. The first that affects our practice, I would say probably the most, or at least that which we have the most discussion about, is Internal Revenue Code Section 174, specifically around R&D. As we all may or may not know, under TCIA, which was passed in late 2017, we had a requirement that beginning in 2022, any research and development type costs that normally could have been currently expensed, historically all the way back to the 50s, had to be capitalized and amortized either over 5 or 15 years, depending on whether it was a payment for a U.S. or foreign-based activity. There has been a lot of support to have this capitalization requirement eliminated, probably on both sides of the political spectrum. It just has not happened. We will talk about what we expect in the future. It may be something that we do expect to be eliminated beginning at some point under new legislation. The question is when, under which package it may take place, but we may see R&D expenditures going back to full deductibility. The question then becomes, like, how far back does that extend? Does it begin in 2025, 2024? We are unsure at this point. What we do know that is that we have and are working with all our clients to identify both credits that are applicable, but also the amount of capitalization that should be recorded as the law stands today. So we're ready for it to the extent that the capitalization requirement goes away, but we shall see what happens. The other area we're going to talk a little bit about under the cost segregation area is bonus depreciation. We've seen that phasing down, and that does have an overall effect on the amount of value that a cost segregation study can bring. And then the third area is around the Inflation Reduction Act. If you were part of some of the discussions around Inflation Reduction Act, especially during the campaign, you would see that it doesn't seem to have a lot of support. At the same time, the energy tax credit provisions do have a disproportionate delivery of value to many red states. So I think we'll talk a bit about the fact that it probably won't be completely scrapped. I think there may be some tweaks and changes to it. Maybe the timing, as long as it lasts, may change, but it is an area that we will talk about in detail as well. With that said, let's move on to a little bit about our group. All right, Tax Credits Incentives Advisory at Cherry Becker is a group of approximately 50 people where we are focused on those activities that generate credits and or incentives. So we're focused on companies that invest in or perform R&D. We're talking to companies as well that just want to lower their liability by maybe purchasing credits. We'll talk a little bit about tax credit, the transferability provisions that came online over the last year, where companies, specifically C Corps more than any other, can purchase tax credits that are that were created under the Inflation Reduction Act. So basically purchasing energy credits. We also will talk a bit about, and again, we're focused on companies that either purchase or refurb commercial real estate, companies that invest in alternative energy, overall companies that hire or expand in certain locations where we're focused on the state credits and incentives available to them. We'll talk a bit about companies that may just be, as I said, adding headcount or implementing software technology systems. So we're going to talk a bit about all these activities that go into generating a credit for our companies that we work with. Okay, so we're going to begin with today. We'll have Tim Doran begin. I'll have him introduce himself, but he's going to talk a bit about the Inflation Reduction Act, what we have seen over the past year, and what we see going forward with some changes around the actual credit that's available. So Tim, take it away.
Hey, good afternoon, everyone. Thank you, Marty. Tim Doran, I'm a director in our practice, and I lead all of our Energy Credit Inflation Reduction Act initiatives. Now, I have a background in tax planning in the energy industry, even before the Inflation Reduction Act came out. But I think that's a great place for us to start. Just a quick refresher on the IRA. Marty kind of teed it up a little bit, but this was a bill that took an existing set of code sections. And I think that's going to be important for some of our political discussion coming up. But there were credits out there for investments into different types of energy sources like solar panels and wind farms and offshore wind, et cetera. And the Inflation Reduction Act kind of juiced them up. It increased the amount of credit that was available, and it created a lot of different ways, as you see on the slide here, of monetizing those credits. With a pretty significant focus on making these accessible to the middle market. Prior to the Inflation Reduction Act, most of the entities taking advantage of these types of credits were large utilities and large developers. And so this created a whole new set of ways to access these credits and then monetize them. Maybe you want to jump to the next slide.
Sorry about that. There you go.
Yeah, so just a real quick couple of areas to be considering for what's changing as we go into 2025. That the Inflation Reduction Act had a lot of different provisions that kind of came online over time. So we were phasing out from different regimes in the old credit space into the new credit space, and we're going to have a whole little section on what that looks like from a technology neutral credit perspective. But a few interesting things that have come up. We've had some calls with folks from the IRS leading the IRA work there, and there's a lot of discussion over audits of prevailing wages. So one of the things that the IRA did to attach on and get it to be politically feasible was it created a concept of prevailing wages. So for certain projects that qualify for these credits, prevailing wages need to be paid per Department of Labor and IRS regulation. And we're going to get the first audits of those. The IRS is working diligently to come out with their new audit technique guides for this stuff. I think there's going to be a lot of new issues that are going to come out of this because these have never been audited before by them. So it'll be interesting to see, but that's coming in 2025. Domestic content requirements. So we're going to talk about direct pay, but there are, for construction beginning in 2024, there's new domestic content requirements. There are exceptions and exemptions that you can document your way out of, but those are going to apply to folks trying to avail themselves of direct pay going forward. We're going to talk about the tech neutral credits. There have been continuing final regulations coming out, continuing proposed regulations coming out. So the regulatory landscape has been evolving since this thing was passed, and it's going to keep evolving into 2025. The credit marketplace, I think, is one of the most exciting pieces that's come online in the last year. A lot of transactions closed going into the typical filing season this fall. And we think there's going to be a host of more credits available and more people looking to take advantage of them going into next year. And then we're also going to touch, as Marty said, on the political landscape that could impact the IRA. The future of the IRA. Yeah. So I think, let's just walk through the slide real quick. There's been a lot of rhetoric with the new administration about tearing it up, getting rid of it. And then there's been a response that, these dollars are flowing into red states. It wouldn't be politically expedient. I think what we're hearing, and you see in the slide, we've heard the word scalpel used. I think that's true for a couple reasons. I think it's the most likely outcome, although nobody knows what the future holds. But these credits existed before the Inflation Reduction Act. So even just saying the words, what does it mean to get rid of the Inflation Reduction Act? The credits themselves have been around for decades. So the likelihood that the credits will completely go away, I think, is extremely low. I think that you're going to see a lot of tie-in with what happens with the changes to TCJA and how those things are paid for. But ultimately, there's a huge bucket of different types of credits that came with these energy credits in the Inflation Reduction Act. And I think it makes sense that perhaps certain pieces of them go away. But at least for purposes of this discussion today, I think each of these areas are going to continue to be applicable, even if there are tweaks to them, right? So these opportunities are going to continue on for at least the next several years that the Inflation Reduction Act is applicable. They just might be a little bit different, but not in the broad application of the way we're going to talk about them today.
And Tim, we hear a lot of how maybe a tweak may be made that the EV specific credits may be the ones that are most vulnerable, whereas we hear nuclear and carbon sequestration have quite a bit of support from the Republicans. And then also just direct pay and transferability, probably the thing we're going to talk about the most here that I think are the most exciting things that ever happened in and around these credits. But I'll let you continue.
Yeah, absolutely. So the tech neutral. So this is interesting. We're about to go into the phase out, phase in of a new credit concept. So for stuff that was, and we still have a little bit of window. So if you have projects, you got to be thinking about beginning construction by the end of 2024, because the old credit regime is still going to apply if you can start construction. But starting in 2025, stuff that's placed into service that isn't in 2024 construction window is going to now be subject to these tech neutral energy tax credits. The idea here being that Congress wanted to capture a broader type of technology, knowing that there's going to be a lot of advancement in this space, and you codify something today, but there could be new technologies in 5 years or 7 years that you didn't even contemplate, that weren't specifically outlined in these energy credits. So the idea was to say, hey, let's throw our net out for anything that's net zero from a greenhouse gas emissions perspective, and then that's how these credits are going to apply. So in large ways, the old investment tax credit, production tax credit, they stay substantially the same except for the technology piece. And there's going to be we just got proposed regulations. There's going to be a lot of comments and probably some tweaks. There are certain technologies that de facto are going to qualify. There's going to be certain documentation requirements for other technologies. So there's going to be a lot of nuance in this space. But I think the really important thing to know is, going forward, if you start construction in 2025 and beyond, you're going to be under a tech neutral concept. And there are going to be certain technologies that are going to potentially fall out that aren't specifically spelled out in the old code and might not be technology neutral from a greenhouse gas emissions standpoint in the new code. So just a quick slide on how you qualify. The new tech neutral are going to apply to facilities placed into service starting next year that you didn't previously take ITC and PTC, obviously subject to repowering. So there's a whole concept around, if more than 80% of the fair market value is replaced in your project, you actually have a new project. That'll still apply. But otherwise, this is a new facility that you didn't previously take the credit on. It's generating electricity, and it has a net emissions rate of 0. So kind of talk a little bit about this. I think one of the things to be wary of is, along with this net zero emissions rate comes a potential recapture, right? So if you have some sort of technology that at the outset is net zero, but due to some technical or unforeseen consequence in the future, begins to produce emissions that go above the regulations for how much carbon you can be pushing out on a net basis, you can have recapture of your credit into the future. So that's going to be an ongoing type of documentation exercise for certain technologies.
Okay. So Tim, I think we'll move on to one of the most exciting things that we have going on here is tax credit purchase.
Yeah, this is awesome. So I think a lot of, our client base, folks we talk to out there in the market say, well, maybe in the future we'll be investing in this kind of stuff, but we're not interested in doing that right now. So how do we take advantage of the Inflation Reduction Act? We're not actually buying solar panels or wind farms or whatever it might be. The way the Inflation Reduction Act created a potential funding mechanism allows for you still to have an awesome potential tax savings opportunity or permanent opportunity. Taxpayers, specifically who are C corps, but there's other potential possibilities with passive income and whatnot that are outside of the scope of this discussion. But C corps in particular can go out and purchase someone else's credits that they can't monetize. So suppose someone puts solar into play and they generate a federal tax credit, but they don't have any federal tax liability to offset. They can go out and sell their credit to get cash in the door, year one at a slight haircut for what the credit would be, and the other taxpayer who has a substantial federal tax liability can purchase that credit, step into the shoes of the folks that put solar into play, and then take advantage of that arbitrage opportunity. The types of technology and eligible investments we're talking about here are the ones we've already discussed: solar, wind, geothermal, combined heat and power, hydrogen, and then going forward, these tech neutral credits that we discussed, right, are going to be the new credits that are going to be bought and sold in this way. Yeah, so this is I think what's interesting here is there are several considerations, but the big thing is this is a congressionally created IRS, Department of Treasury authorized and regulated marketplace, broadly speaking, right? The rules are there to take advantage of this. It's designed to fund these credits. So there is intent here by the federal government to create a funding mechanism for the credits. And so there's even an IRS registration process. This is a blessed opportunity from the federal government, but there are different considerations you have to take into to play. One of them is that it's got to be a cash transaction, and this is a one-time transaction. So there's no ongoing price of a credit in the market. This is one seller, one buyer, one time, right? And the credit moves, and you take advantage of this arbitrage opportunity. And once you do, it's irrevocable.
Yeah, and one of the most important things to keep in mind, and I think it might even be better spelled out on the next slide if I remember, or maybe the one after that. Well, let me go back. Sorry about that. Is that these are passive credits, meaning that we're talking to many C corporations about the ability for them to purchase tax credits to the extent they have a tax liability. The C corporation is not generally subject to the same passive activity loss limitations that other taxpayers are. And so as these are passive credits, it really applies in the C Corp world. With that result in mind, we are focused on talking to all of our C corporation clients that have a tax liability and trying to help them understand exactly what it is we can provide for them, which is both helping to introduce them into the concept, the marketplaces as well that list these credits, help them understand what a really like market price makes sense with respect to the particular credit type, get a sense of who the player is that's put that credit into place, any recapture that may result after purchase, but really help to sort of like be their guide through the entire process as they consider whether it makes sense for them to purchase credits. And it generally does to the extent it is over a certain amount. But Tim, what have you seen as the overall price right now with respect to credits, at least around the 23 credits that we found in 24? We're going to find more going next year.
Yeah, absolutely. I mean, we could talk about all the different factors that go into what determines the price, but I think generally speaking, somewhere in the high 80s, low 90s is a pretty solid price point for a credit. So you're getting a 10 to 12, 13% arbitrage on your cash against your otherwise owed federal tax liability. And to Marty's point, a lot of the work that our team does, we have years and years of doing the due diligence on these credits for taxpayers who were actually going to claim them on their return, because there's some sophisticated rules and different things. And we're able to bring that expertise to help folks access this marketplace and take advantage of that opportunity. And there you go. There's the opportunity right there. You got the arbitrage opportunity, but there's another wrinkle to this, which is really awesome. And that is that the IRS has came out and said, if you intend in your tax year to be purchasing these credits to offset your liability, you can factor that into your quarterly estimated payments. And so I think one of the concerns is, well, hold up, I gotta outlay all this cash to buy a credit, and then I get to take advantage of it on my return. Well, it's the opposite. There's a timing benefit here, because you're not going to file your return to the year after the current tax year, right? So you can delay those payments out to the IRS, potentially time your cash payment to purchase the credit into the next year. So you get a delay in your cash going out the door. And then on top of that, you get this awesome permanent arbitrage benefit.
Yeah, and we don't see any new legislation threatening this, at least for what we had for 24 credits. It's been too late for that, and I think the marketplace has developed too much, and it's benefiting too many taxpayers. If anything, it's a tax reducer for many companies out there. All
This
right.
would be a very difficult thing to take away in the near term. I think that's right.
Yeah. Okay, so have you discussed the purchase of tax credits for your C corporation? I guess that matters if you have a C corporation, but the potentials are yes, no, or not applicable. So we'll take a minute to have that answered here, and then Tim, beyond the transferability provisions, the next thing we're going to talk about, and I want to get ahead of it a little bit, so maybe we have time for everybody else. It's a concept of direct pay or elective pay. And why don't you talk a little bit about what a game changer that was as well for certain other kind of taxpayers, so we can jump ahead of what's going on.
Yeah, absolutely. Yeah, we can move through that. This is awesome. I'm not a federal taxpayer. I'm a not-for-profit. I'm a county. I'm a local governmental jurisdiction. But I want to get involved in some of this solar stuff or battery technology or geothermal or whatever it might be. There's a new provision where you can get a check back for the credit you would have otherwise generated if you were a federal taxpayer. And there's a couple different provisions that apply. There's a registration portal. There's some things like domestic content that you have to be worried about going forward in terms of calculating your credit. But it's an awesome thing. It works as like I use the words like an ex post facto grant, right? So, but it's better than a grant, because you're not applying to get dollars sent to you. If you do the thing that the code says you can do, you're going to get the money. There's a little bit of a delay. You have to put it into service first, but we're talking 30, 40, 50% potentially back on your investment into these technologies that you're able to get a check from the Treasury. And the turnaround has been faster than we expected, right? So I think they said 45 days after your filing deadline, but we're seeing people getting it weeks right now after their filing deadline. They're getting a check back from the Treasury for this property that they're putting into service.
Okay. Yeah, so direct pay, again, Tim, we in the credits and incentive space have always been focused on taxpayers. Now we are focused not only on those that or like not are for-profit businesses, but we're focused on not-for-profits and governments who may be able to take advantage of these credits. And that's not just the credits, that's also some of the deductions associated with like some of the energy efficiency commercial buildings under 179D, which we'll talk a little bit later. That can be eligible to both governments and to not-for-profits as well. So Inflation Reduction Act not only increased the number of credits, increased the amount of some of the incentives under 179D, but also increased the number of individuals or companies or organizations that could take care of this. A lot of it is new. A lot of it involves registration with the IRS, whether you're selling credits, whether you're asking for direct pay. We've had quite an education over the last year when it comes to how to understand how to make this work. We have a lot of affiliation with our not-for-profit tax group as well. And so everything from understanding the credit amount, the type of credit, how it's calculated, how it needs to be documented, to doing the filing and actually monitoring how that comes back is something that we've been helping many, many taxpayers with. That may be it. Maybe you want to talk quickly about how direct pay works, and then we'll move on to the next one, Tim.
Yeah, let's just walk through it. So a tax exempt organization makes an investment in all the stuff we've been talking about for the last 10, 15 minutes. In that tax year, they're going to notify the IRS that they're going to claim this direct payment. There's a portal that you go into, and you have to give them some information. And then you file a return. For most tax exempt entities, it's a 990-T. It's very much an informational return. Most of these people don't pay federal tax, and you attach the appropriate forms that a regular taxpayer would be filing that evidence all this different stuff about the technology, and then you get a check back. It's a really awesome opportunity.
All right. So that is our focus on, we'll call it Inflation Reduction Act, energy credit specific of the discussion, looking forward going back. With that said, I'm now going to have Vivian Kors introduce herself as we start to begin to talk about, and Carolyn Driscoll as well, as we begin to talk about what we see in R&D and the changes there.
Hey everyone, I'm Vivian. I am a director in the Tax Credits and Incentives Advisory Group, mainly focusing around R&D tax credits as well as Section 174. Carolyn?
I'm Carolyn Driscoll. I am also a director in the TCIA group, focusing on 174 and R&D.
Awesome. Well,
You.
just a few things that we want to make sure that we're covering with you guys today. Unfortunately, as of right now, the Section 174 capitalization is still mandatory and it's a requirement. Like I said, I know earlier in the year there was a bill that was passed in the House that eventually got shut down, but there are definitely potentially, well, not say definitely, there are definitely potentially something that's going to come in the horizon next year that could potentially either allow for the timely deduction of research and experimentation costs again. And the mechanics of that yet to be seen. There are definitely different ways that the Congress could approach this, either in a way of going retroactively back to 2022, or it could just be a 2024 thing, or it could not happen at all. So with that said, we definitely want to make sure as you are tax planning for the year that you are hoping for the best, but planning for the worst. Meaning you are looking at your 2024 R&D spend when you are preparing your either your provisions or you are estimated payments and things along those lines. One key factor that I want to make sure that we're bringing up is that the R&D tax credit does not create a capitalization. The capitalization is a requirement even if you are not taking the R&D tax credit. So what that means now is that the R&D tax credit is more beneficial than ever because it allows you to offset your additional tax payments that you might need to make because of the capitalization, or it potentially will bring you out of losses sooner than you expect because of the required capitalization. So everything goes along the lines of tax planning. There is also, in terms of the way you sell your business or you sell your R&D assets, that could result in the write-off not being permitted. So if you are thinking of selling your business, make sure that you contact us so that we can plan everything out and look at everything for you so it's a holistic view of your tax posture.
Then we're going to dive into the new disclosure requirements. Some are new and some are newer. The proposed Form 6765. We'll talk about that. The employer payroll tax offset for 2023 and going forward is up to $500,000. And what to look for analyzing prior tax years. You do have to retroactively elect the alternative simplified credit. And we'll also talk about how quite a few companies are moving away from contingent fee providers.
Yeah, we have an overall theme that we've been developing lately. We've had it forever, but we're trying to articulate it better is because some companies have had the opinion that they can't utilize these credits immediately, that they should not look at them right now and kind of blow it off and wait for the future. We couldn't disagree more for a number of reasons. One being you may lose out on certain elections that could have been made to get you a bigger credit when you do go back. And then beyond that, best to understand exactly what credits are available to you and what that capitalization is. Understanding what the capitalization is, the best way to get it right is to do a credit study so you can really value what your NOL remaining is as you approach the potential of being a taxpayer. So lots going on. It's always worth taking a look at it now, and we're always willing to take a quick look at it on a complimentary basis just to get you understanding. All right, now our second polling question is, have you changed your accounting method to adopt Section 174 capitalization and amortization? Interestingly, we've some companies out there that decided they would just stop claiming an R&D credit beginning in 22 because they didn't want to get hit with that capitalization. I think they may get hit with an IRS IDR at some point. it to the extent they've been doing that. Again, as Vivian said, the most important thing to keep in mind is that looking into claim a credit does not in any way trip you into capitalization. You're there anyway. The IRS is issuing IDRs around Section 174. We've seen them. And it is something that they can take up your time with quite a bit. And so even if you didn't capitalize, please reach out now. We can true that up, file Form 3115, do our best to help you model out what amount of tax may be due. There's quite a bit there that we can do. And perhaps the capitalization isn't as high as you think it thought it would have been. With that said, okay. Yes, for 25%, no, 27%, I don't know, 15%. Okay, not applicable, 34%. So the I don't knows, we're happy to talk to you. Anyway, with that said, we'll move on and I'll be a little more quiet than I normally am, but let's see here. All right, we're going to talk generally about R&D and I'll let Vivian take it away.
Actually, Carolyn's going to take this
Carolyn,
away.
take it away then. Carolyn, take it away from Vivian. Good stuff.
However, I think everyone on this call is pretty well aware of the 4-part test, and in the interest of time and some more pressing and interesting issues, we are going to move on to the next slide.
Yeah, just the most important thing here is when we're talking about R&D, we're talking about not only we're talking about development of new product, process, or design. We're also talking about almost anything that's software development. It has some R&D component at times, but it definitely has a 174 capitalization component.
Absolutely. Again, QREs, the different categories, wages, supplies, contract research, cloud costs, cloud hosting costs, and things like that. We've got a sample information request. Looks like a lot, but it really isn't. We do complementary scoping, as Marty mentioned, and with a little bit of information, we can really give you a full picture. Again, 2 methods, right? Traditional method, alternative simplified credit. Not going to read this to you. Most people on this call very well aware. We always do run it both ways because we're trying to identify the most beneficial to the client.
Now back to the required capitalization. So this is kind of a summary of what kind of goes from an R&D tax credit, which I would say is a smaller subset of Section 174 costs, to the bigger picture of all costs incidental to R&D. So Section 174 costs really are things along the lines of your wages, but instead of just being your Box 1 W-2 wages that are related to R&D, it's gross wages plus your benefits and your fringe and outside of that. So it's basically starting at a smaller point, which is your qualifying research expenses, as Carolyn was talking about, to the bigger picture of what else is incidental to your R&D. In addition to US costs, which are basically the only eligible costs for the credit, we, for 174, have to look at your offshore costs. And that's the distinction there is extremely important because your onshore costs are capitalized and amortized over 5 years versus your offshore costs are capitalized and amortized over 15 years. So the recovery period is quite different, and you will get hit quite differently. And I know a lot of companies, at least the trend that we are seeing, are moving costs offshore for cheaper labor. So that's something to definitely consider as well as you're looking at your Section 174. In addition to your direct R&D type costs, other G&A costs could be allocated similar to how you would a UNICAP study to your R&D. So say, for example, your rent, your utilities, your depreciation, those are all things that you would need to consider how best to allocate based on your facts and circumstances.
Really quickly, Vivian, whether Biden, whether Trump, big push to onshore activity. And when we see the proposal to change and go back to being able to expense these R&D expenditures, it didn't apply to foreign. So this kind of thing may still apply going forward, irrespective of what happens under the tax law. So we've gotten pretty good at doing these allocations, understanding what is truly R&D related. But for companies that have a large amount of like offshore software development, we may still be doing something like this, and they may have to actually be continuing to capitalize and amortize it over a 15-year period. So I think all of the practice we got during the last 3 years on 174 will not be for naught, because I think while there may be some alleviation of the pain, it may not be complete. And so there may be still a push to penalize those that do much offshore.
Absolutely. So when we're talking about R&D, what that really means in the Section 174 world is specified research and experimentation, which can include things that you are trying to develop, such as pilot models, process, formula, technique, invention, patent, computer software, and new products. So I want to highlight what kind of Marty talked about. Computer software, a lot of times people are like, oh, I've put this software in, it's been in production for years now. I'm not really doing anything else. I urge you to look more closely, because there are a lot of times you're continuing to try to iterate upon your software, either to make it perform better or to provide new features and functionalities. And those improvements to your existing products could be 174 that you would need to capitalize. So that's something to definitely look out for. Oh, and I talked about this. So what we do is we want to make sure that we're, again, maximizing your credit while minimizing your Section 174. And that looks at the activities and the costs associated with your different types of R&D. As it's specific to software development, we want to make sure that we're breaking down the costs associated with designing, building, writing source code, testing of your new features and functionality versus your maintenance, your data acquisition costs, your simple data conversion, or your installation, production, and like tech support type costs. So that's something that you want to differentiate on your own, or you want to make sure that you're getting somebody to look at it.
And routine configuration would be in the activities not considered software development.
Yep. So to the extent you're spending a lot of time configuring your ERP system that you're hiring somebody to do, that would not qualify for 174 or for the credit. And then this is probably one of the most important parts for folks who are performing R&D for your customers. So this could be your government contractors, your professional services. Costs for R&D tax credit have to meet a rights and risk test, meaning the taxpayer needs to bear the economic risk and retain development substantial rights to your development to qualify for the credit. The rules are different for Section 174 capitalization, and it's actually an OR test, meaning, again, it's going from a smaller subset of qualifying research expenses to a larger subset. So to the extent that you are getting paid time and materials, but you retain the rights to the development, you would still have to capitalize for 174. Again, this is an OR test, so it would be imperative to look under some of your larger R&D contracts and see how things are structured to make sure that you are doing your analysis in terms of, hey, this contract and the activities and the costs associated with it is R&D, but do I bear the economic risk or retain the rights? And then a lot of times this creates a double capitalization if you are paying your corporate that is located in a foreign country to perform R&D on your behalf. Again, those intercompany transactions or those intercompany like IP setup is very important in the world of Section 174.
Government contractors especially need to keep in mind as they do a lot of work on behalf of someone else, but they also sometimes even employ third-party subcontractors on their behalf. So there's a whole down the chain analysis to understand who has the economic risk, who has the rights associated with that, and you can trip yourself into multiple layers of capitalization at time. And so it is worthy, as we say, look at it now, not later, of what we can do, not just from a credit or compliance standpoint, but rather from an overall planning standpoint. One of the things we're going to talk about now is disclosure, and this will be the last thing we talk about on R&D. So big deal, biggest deals that we've seen around R&D, again, capitalization, required or not, foreign versus domestic capitalization. Now, also, when you file a credit claim, or just a credit at all on a timely filed return, historically, pre-2022, a taxpayer just had to basically do the calculation, get the numbers on the return, and then do the filing. Beginning in 22, in January, the IRS put into place a regime where for amended returns, the taxpayer actually had to beyond just provide the submission of the claim for refund, also provide a disclosure that had certain pieces of information, less than is listed right here because they took it down a little bit. But since January 22, to the extent you, as a taxpayer, failed to file the disclosure, you could still have a 45-day period to cure that without having to refile the whole thing. And you have to list what the business components were, basically the projects in which the credit relates, all the activities performed for each business component, and the total QREs associated with each. Again, that's less than it used to be because you used to have to list all the individuals and things like that, something that would normally sit in an R&D study. Nevertheless, the IRS won't process it for an amended return unless they have this, and they will kick it back to you. And again, give you 45 days. Just recently, they extended this 45-day grace period into 2026, where it did not exist before. But this is especially important for companies that at the last minute file an amended claim where the statute's about to expire. To the extent, say, they forgot to do this disclosure and this 45-day grace period weren't there, you would have lost your opportunity. This opens it up and gives you an extra 45 days to cure that filing, and it's a big deal. They keep extending it, which makes me think, I wonder if they always will, but we shall see. And it's now set to be there through 2026. This is for amended claims for refund. Going forward, Carolyn, you talk about this part? I can't remember. Yes, I think, right?
I can.
Yeah, why don't you? This is the Form 6765 and the changes that are being made for beginning in 25.
Back to what Marty was saying, the 45-day letters, we have filed a number of amended claims for refund, and I've seen 2 45-day letters. So it's not prevalent, and it is very similar. We file an amended return. If we don't get a 45-day letter, we still may be waiting for a year for any type of response. However, all right, so new Form 6765, it's still in draft form, and it is not required for 2024 tax years, but it will be required for 2025. And it's asking for more information. In fact, it's very similar to the disclosure requirements for claims for amended return. It's asking for, well, let me tell you that it's A through G, and taxpayers who have 1.5 million or fewer in QREs on a control group basis, and have fewer, again, on a control group basis, than 50 million in gross receipts, do not have to comply with Section G. And that's the one that looks like the disclosure. So things that all companies will have to comply with for 2024 are Section E, the number of business components, officers' wages, were there any acquisitions or dispositions, are there any new categories of research, and did you in fact take advantage of ASC 730? Section F on the draft form is digging deep into QREs. Oh, here we are. Yep.
It basically just changes the order of many of the things and requires many of the things that normally would have sat in a binder or on a hard drive, specific to a what's known as an R&D study, had to be sort of pre-populated into the Form 6765 going forward. So when we talk about doing an R&D study and what needs to be filed, I think this really does cut at a number of contingent fee providers out there. There's kind of like our chop shops that will work to help file a return, move on, and try to take a contingent fee off that. There really is a lot of thought that needs to go into your R&D study. You should definitely claim it if you are able to, due to the fact that capitalization may hammer you anyway. But we just want to make everybody aware there's going to be more coming when it comes to the, I don't know if it's a burden of documentation, but the requirement that I think we've always been doing anyway and waiting for it on the back end. We're just going to show our hand up front and show that we did our homework to the IRS.
Absolutely. So we are waiting for instructions for the new Form 6765, and we're hoping they're going to be pretty robust because there's no guidance currently on statistical sampling, disposition of a major portion of trade or business, new category of expenditures, and control group. All right, let's move right into cost segregation. If you do have any questions on the new form, there are I'll say little Sandy Cole and direct supervision, there's direct support. There's a lot of moving pieces that we don't have time to get into right now, but we're happy to have a discussion.
Absolutely. So let me now introduce Glenn Lemieux, who joined us in April of this year to oversee some of our real estate construction credits, cost segregation, and 179D. And we'll talk a little bit about what we've seen this past year and what we may see going forward.
Yeah, hello everybody. Glenn Lemieux. I'm a director here. Happy holidays. So appreciate your time. What I'm going to be talking about is cost segregation and 179D deductions. Both can be very beneficial, and if you combine them, they can be extremely powerful tool in your tax planning. So cost segregation should be part of your overall tax planning if you're a commercial or residential owner of properties. What we're trying to do is increase the cash flow through accelerated depreciation. How we do that is we take the assets of commercial or residential and break out the properties that we are allowed to depreciate faster. So typical on a commercial building would be 5-year personal property like carpeting and cabinetry. 15-year properties are land improvements, so anything exterior to the building structure. And when you combine those with the acceleration of just the shorter life and you add bonus depreciation, those can be very powerful. So bonus depreciation is generally eligible to any asset under 20 years of a life. So for 2024, the bonus is 60%, and that is decreasing 20% every year until it's gone. Just a quick note on that. This is a personal opinion. But the opinion of many people I've talked to in this industry is that the bonus is likely to go back up to 100% here with the new administration. So that's kind of good news for everybody. So ideally, doing a cost segregation in the first year of in-service is the best time. But the great thing about cost segregation and 179D, what I'm going to get into, is that you can do those in prior years. So if you had a building you bought 2 years ago, we can do that study for you in the current year. Just by filing a 3115, we pull all that depreciation forward into the current year. So that can also be a very powerful tool in your tax planning. So, as we're digging around and doing the studies, we're seeing a lot of your data and seeing a lot of the information. There's other benefits that pop up, and I'm just going to, identifying some potential credits, deductions. There may be some personal property tax issues that we can help with and identify. And then information on building systems that might help with applying tangible property regulations. So the next slide is kind of just an example of a typical commercial building you bought for $3.9 million, no cost segregation. You're depreciating all $3.9 million over 39 years. And so what that looks like is $100,000 a year, basically for 39 years. If you do a cost segregation study, the potential first year depreciation expense can be significant. So, $1.2 million versus $100,000 is quite substantial. And then because you're pulling all that into the first year depreciation, the first year in service, then your second year depreciation will go down, obviously. So that's quite a difference. So your overall tax savings on this example, using a 40% tax rate, could be about $456,000. So,
all right. Polling question number 3, and I'll encourage maybe Glenn or somebody, if there's any interesting questions in the chat you want to get to while I'm going through this, that might be interesting. But has your business purchased or constructed real estate in the past 3 years? If so, we probably want to talk to you because you may be eligible to look at cost segregation. Yes, no, or not sure. I don't know if anybody has been able to see the chat or pull it up. I can certainly do that. But before that, Glenn, one thing that I've noticed over the past year is it's not just because bonus is going down, but I think it's because 179D became so much more beneficial, is that you almost have like a cost seg plus. It's cost seg plus 179D on the side. And while we're waiting for these answers to populate in, if you want to talk just quickly about 179D, just so we can make sure we can hit times to allow Melinda to talk.
Yeah, absolutely. So like the cost segregation, 179D is the deduction. So it's an energy efficient commercial building deduction that is available to building owners and designers. It came into law in 2005. It was updated a few years later to include the non-tax paying government entities where they can allocate a deduction to a designer. So it's a square foot deduction on commercial buildings and some higher rise residential buildings. And it's based on meeting an energy efficient standard. generally speaking, the way the standards are right now, you're comparing a current building to a building built in 2007. So generally, most things will qualify for somewhat of a deduction if you meet all the other regulations. So what it does is it looks at really three areas: building lighting, envelope, and HVAC systems. Prior to 23, that the max square foot was about $1.88. After the Inflation Reduction Act, that bumped up to $5 a square foot max, with some other, there's some prevailing wage issues and some other things in there. But and then adding inflation onto that, so that was quite a bump for the 179D deduction.
I don't know if this poll is going to close anytime soon, but
So
hopefully.
just like the cost segregation, 45 or 179D can be, again, we can do studies on prior buildings and pull them into the current year. So it's again a Form 3115. So there, we just went over that. You can go on the next one if you want, Marty. So really, yeah, we talked about that. And one thing that we'll go to the next one. So this is really exciting stuff here that happened in the Inflation Reduction Act. Prior to this, churches, charities, all these listed here, tribal lands could not benefit from a 179D deduction because they didn't, they're tax exempt entities. Now, after January 1st of 23, those entities can allocate their deductions to designers. Now, there's some very rigid restrictions on what a designer is, but it's kind of a new thing we're seeing a lot of. We're doing a lot of work in that area. And, another big one was the 4-year reset. Before, you did a cost set or 179D one time on a building. And now with major renovations, you can do it every 4 years. So that's another added benefit. And then again here, that the maximum deduction went up to $5, and $5.36 is with inflation per square foot. So what I was referring to real quick was the prevailing wage. Anything to get to that $5 a square foot, you have to, and there's a sweet spot in there, but in general, anything starting construction now, you have to have, there's a prevailing wage requirement where generally everybody on the project that is on site needs to pay prevailing wage and have an apprenticeship program that they can prove is in place. So it is a little tougher to get to that higher deduction, but it can be, the juice can be worth the squeeze on that in certain projects. So the sweet spot I'm talking about is if you started a project prior to January 30th of 23 and you put in service anytime later, you can get that $5 a square foot deduction without the prevailing wage requirement. So that's a really, really nice benefit if your project fits in those timelines.
Yeah, it does. So main takeaway, if you have a commercial building where you made either recently constructed or made upgrades to the lighting or the building envelope or the overall HVAC, please talk to us because somebody's going to get something out of that.
Yeah, and if you have anything, please reach out. Tax time's coming up, busy season's coming up, so we'll be glad to help you.
You have any planned capital expansion in the next 2 years? This is the fourth and final polling question. Yes, no, not sure, or not applicable. As we take our time to answer this, we're going to move on. Glenn, by the way, thank you so much for joining. And everybody, I almost apologize that there's so much here to go through so quickly, but it is to get through some of the high level and most interesting stuff of back and forward. Melinda Young is without a doubt one of the most important directors on my team and kind of plugs into everything that we do because we're always focused on, from a state and local perspective, what may be available from a negotiated perspective, a statutory perspective, et cetera. Everything from hiring, et cetera, job creation. But Melinda, take it away, give a little bit about you, and then we can jump ahead into what you're going to talk about.
Thank you, Marty. This is Melinda Young. I'm a director in State Credits Incentives. So there are 6 main triggers for state C&I opportunities when you're expanding, relocating, or consolidating, when you're adding job, maintaining job, providing training to your employees, or when you're making investments, or when you're going into a new state or starting a new service, a new product line, or lastly, if you are expecting an M&A transaction, especially in asset acquisition. These are all great indicators that you may qualify for either statutory credits, the ones that you typically see on a tax return, the ones you can go back and claim retroactively, or you can qualify for discretionary incentives. So these are the ones that you have to negotiate with the state in advance, and it's usually based on your spending and job creation going forward. And what should we expect in 2025? Taxes remain a very important driver for economic development and also population migration. As you know, the Great Migration started back in 2020. Americans are moving from a higher taxing jurisdiction to a lower taxing jurisdiction. Also, Americans are moving from a higher cost of living to a lower cost of living. And that move continued through 2023 and also in 2024. And based on the population migration map, Americans continue to move from the West Coast to the East Coast with a very heavy concentration in the Southeast area. And you'll notice that states with neutral tax structure tend to rank higher compared to other states. If you take a look at the table, represents how competitive the states are in 2025. Almost every single taxing jurisdiction imposed a property tax and also imposed a UI tax, unemployment insurance tax. In states that are missing one of the other tax category, for example, income tax, they tend to score higher. And the top 3 states are Wyoming, South Dakota, and Alaska. Given that Wyoming and South Dakota, they don't have any corporate or individual income taxes. And also Alaska doesn't have individual income tax, and also it doesn't have a state sales tax. If you take a look at the rest of the states, Florida, Texas, and Tennessee, they rank pretty high because they also do not have an individual income taxes. And compare them to Georgia, which ranks at 26 overall, right in the middle of the pack. It's because they're competing with Florida and Tennessee without individual income taxes. And also they're competing with Alabama and North Carolina, who have lower tax rates. If you take a look at the bottom of the list, you see California and DC are at the very, very bottom because they have very high individual income taxes. And California also has a very high sales tax, and DC has a very, very high property taxes. So taxes and economic development were the main topic in the Trump administration. So we are anticipating a lot of new changes coming up at the federal level, which could result in direct impact to the site selection process. And the site selection is a process of choosing a location for your facility or your business to improve your efficiency, reduce risks, and create a path for long-term success. So there are 4 major impacts. In significant tax cuts and deregulation and changing the trade policy, we are anticipating an increase in domestic and foreign investments in the US, so more American-made products. And increasing workforce development, we are anticipating a lot of job creation, also job retention. And last impact is the infrastructure investment. And this will improve our logistics throughout the US and also increase our transportation networks, they are major impacts in the site selection process. So these are all the major impact at the federal level. So what's happening with at the state level? So there was a surge in state tax collection during the pandemic, resulting from the $800 billion federal stimulus package that increased our consumer spending that led to additional sales tax collection. And also it has been a really tight labor market that increased our income and lower unemployment. According to a 2024 State Fiscal Office survey, we have identified 4 state tax trends. All but 2 states, which are Alaska and Nevada, have all had tax cuts since 2021. Some states have more tax cuts than other states. And some states have tax cuts every single year from 2021 to 2023. And some other states have tax cuts, multiple cuts within the same year. So 6 states actually reduced their corporate income tax rates. For example, Marty, if you want to go back up.
Sorry.
So example, Georgia actually reduced their income tax rate. House Bill 1437 accelerated the income tax reduction by 10 basis points starting 2025, going from 5.49% down to 5.39%. And additional 5 states also offer individual tax cuts. In South Carolina, House Bill 5100 accelerates reduction from 6.4 to 6.2, and that's in addition to the one-time property tax credit they offer, which total about $500 million in overall statewide property tax cuts. And so other states have also followed South Carolina in providing property tax cuts as home value goes up and your property tax value also goes up, and your property tax goes up as well. At least 13 states have offered some form of property tax abatement or tax cuts. And another important trend is a lot of states are offering additional sales tax exemptions. And it's because that businesses are increasing their operating costs. So the states are offering sales tax exemption to help them reduce their financial burden. In Indiana, starting in 2025, the state is actually going to offer a 50% sales tax exemption on utility purchases, even without a utility study. And that's only for the restaurant business. And lastly, the most important trend is, and also the most beneficial trend is the states are expecting to offer more customized training incentives package. And that could be cash grants, property tax abatements, sales tax refund, utility incentives, anything you can ask for. And so whether you're making investment or creating job, this is the perfect time for you to take a look at all your current operation and your future projections. And CNI is a great opportunity. It would help you get it can offer the dollar for dollar value. It help you reduce your operating costs and also increase your cash flow.
All right, everybody. I just want to say thank you to my team, to Melinda, to Glenn, to Tim, to Vivian, and to Carolyn. I don't do anything of value without them, honestly. Can't help but thank them enough for this, and thank everybody for joining today. If you're here, you got the CPE and you answered the 4 polling questions. Our contact info is here as well. Thank you so much for joining. To the extent anybody has any questions, please reach out to me and I'll make sure you get the right answer. Appreciate it. Thank you.